Many companies are sitting on a mountain of cash. Today is February 17th, 2026, and a strange quiet has settled over the corporate world. The frantic hiring sprees of a few years ago are a distant memory. The ambitious expansion plans have been shelved. Instead, balance sheets are swelling with cash reserves, larger than many have seen in over a decade. This isn't a sign of booming success waiting to be deployed. It is a signal of deep-seated caution. It is a story about past mistakes, present costs, future fears that are shaping the global economy in ways that affect everyone. You might look at corporate reports and see record profits. You might then ask a simple question. Why isn't this money being put to work? Why aren't companies investing in new factories, innovative research, a larger workforce? The answer is not a single, simple truth. It is a complex braid of three distinct threads. The first is the painful memory of growing too fast, too soon. The second is the hard reality of higher interest rates. The third is the relentless pressure from investors demanding stability over risky bets. The first major reason for today's corporate caution is the ghost of post-pandemic overexpansion. Think back to the years immediately following the global lockdowns. A surge in demand, fueled by stimulus checks and a shift to online life, created a frenzy. Companies in technology, e-commerce, and logistics mistook a temporary spike for a permanent new reality. They went on a historic hiring and spending binge. Annual reports showed hockey stick curves. To not expand was to risk being left behind by more optimistic competitors. Companies leased huge offices, built sprawling warehouses, onboarded thousands, and paid up for acquisitions to grab share. The mantra was grow at all costs. The assumption, consumer behavior had permanently changed. It proved a costly miscalculation. The correction was swift. People returned to stores, travel, and dining, and bought fewer gadgets. Growth engines sputtered. Enormous payrolls, empty offices, oversized supply chains turned advantage into liability. The lesson: after painful layoffs and write-downs, boards reject big spending, choosing a fortress of cash, a self-insurance against past optimism. The second powerful force compelling companies to hoard cash is the end of the cheap money era. For more than a decade, rates were near zero, making borrowing incredibly inexpensive. Companies used cheap debt for share buybacks, acquisitions, ambitious growth projects. Risk-taking was rewarded. But those days are over. To fight inflation, central banks raised rates significantly and kept them there. Suddenly, borrowing is expensive. A loan that cost 2% might now be 6 or 7. Many projects no longer pencil out, from new factories to software platforms. Companies get selective, shelve ideas, or fund only essentials, often from cash reserves. Furthermore, higher rates make holding cash attractive, parkable in short-term government bonds or high-yield accounts, earning respectable low-risk returns. Billions in cash can generate tens or even hundreds of millions in interest, turning safety net into profit center. Banks tighten credit, even for large firms. Uncertain access pushes self-reliance. Holding big reserves becomes necessity to meet payroll and supplier payments without the whims of a nervous credit market. The third critical factor is the immense pressure from investors. The speculative fever has broken. In 2026, investors demand prudence and predictability. They want strong balance sheets, consistent profits, a clear, low-risk path forward, and punish wasteful spending. Leadership knows compensation and tenure hinge on the stock price and major shareholders. Big, risky bets can trigger immediate sell-offs. In contrast, plans to build cash, pay down debt, and return capital via dividends or buybacks earn approval. It signals discipline and protection of shareholder value, favoring short-term certainty over long-term bets. A large cash pile signals resilience, avoids bad timing capital raises, and preserves strategic flexibility. It's a war chest pleasing cautious investors, often at the expense of R&D and organic expansion. Many prefer dividends today over 10-year moonshots. CEOs manage for this quarter, not the next decade. Prudence is rewarded, bold vision, suspect. This corporate strategy of hoarding cash has direct and tangible consequences for workers. The most immediate effect is a slowdown in hiring. When focus shifts from aggressive growth to cost control to balance sheet fortification, expanding the workforce is first on hold. Open roles stay vacant. Projects that would create jobs are delayed indefinitely. More applicants, fewer available roles. Employees feel it in pay and progression. Smaller raises, wage freezes, rarer promotions. Companies flatten layers, internal mobility shrinks. Ambitious people feel stuck. Job security becomes central. Consider a large software company. In 2022, thousands hired. By 2026, after overhiring, it shifts. Billions in cash, strict hiring pause, reduced bonuses, raises only for top performers. Profits remain high, but workers feel stagnation. Operational efficiency justifies cuts. Savings feed the cash hoard. Stability first. Headcount adjusts to protect the bottom line. While effects on workers are direct, consumers also feel the impact, often more subtly. Pullbacks in investment slow innovation, money for R&D sits in accounts, fewer groundbreaking gadgets, less innovative software, slower service improvements. The drive to out-innovate is dampened by safety, and customer experience can suffer. Store renovations delayed, older, less comfortable planes, telecoms slow next-gen rollouts to save capex. Companies stay stable and profitable. Customers get less than they could. Streaming shows it clearly. Growth at all costs spawned massive slates. Now, with profitability, the mandate, budgets are slashed. Fewer big-budget series, more low-cost reality, fewer ambitious sci-fi epics. The platform remains, the value feels diminished. Another side, cash buffers help in downturns. Resilient firms keep stores open and absorb costs longer. Corporate stability can act as a shock absorber, preventing failures and preserving choice over time. In summary, the trend of corporate cash hoarding in 2026 is not born from a single cause, but from a confluence of powerful forces. Haunted by post-pandemic overexpansion that left firms bloated and vulnerable. Disciplined by higher interest rates that make borrowing costly and saving attractive. Guided by investors who reward stability and predictable returns over risky bets. The result, a mindset geared toward defense, not offense, a massive trade-off. Short-term, firms are stronger and more resilient to recessions, supply shocks, and demand swings, preserving core employment. But economy-wide caution drags growth. Fewer jobs, less innovation, delayed infrastructure. Piled cash is potential energy, fuel awaiting a spark. Watch for 3 signals to unlock spending. First, a sustained demand rebound. Second, rate cuts. Third, investors rewarding long-term growth again. These decisions shape jobs, wages, and consumer choice. Understanding why companies hold cash is the first step to seeing what happens next. If you want to understand what's really happening, watch the next video in this series. Please like, comment, and subscribe to Pulse Explained.